Estimates last meeting of FY 2023 and first meeting for myself and for Secretary Grady as board members. Secretary Grady, welcome to the Treasury building. And Treasurer Davis, once again, we look towards you as the seasoned veteran among us. But it's great to be here. The BRE performs one of the most important roles in state government, forecasting our state revenues. Our work sets the foundation on which the budget of the state of Maryland rests. It informs the work of the governor and the General Assembly and ultimately impacts every state resident of Maryland. The BRE also provides essential information about the current and future state of the Maryland economy and our revenue structure. This information has incredibly important policy implications relating to employment, commerce, social services, and more. That is all to say, I'm very excited to sit on this board and honored. I take our role very seriously and I look forward to the work ahead. And with that, I'm happy to turn it over to Treasurer Davis, if you have any opening comments that you'd like to make.
Thank you. Good afternoon, everyone. First, I'd like to thank my colleagues, Comptroller Lierman, Secretary Grady, and to the Board of Revenue Estimates. I look forward to working with you on this board. I'd like to start by saying that we got great news yesterday as it relates to our AAA bond rating, which will keep interest rates on the state's bonds low and save Maryland's taxpayers millions of dollars. Today's news that you're about to hear is somewhat surprising, and we can point to many factors which regarding the COVID recovery, supply chain issues, interest rates, inflation, and the list can go on and on. However, it should not change the course that we're on. We must continue to strike the careful balance of catering to our critical needs while exercising a degree of caution moving forward. In their report, Fitch Ratings said the state has a long history of proactive budget management to maintain adequate reserves and enact expenditure reductions when needed, which we expect will continue. I believe the governor and the General Assembly will work together to proactively manage the budget while making important investments to support Maryland and its economy.
Thank you so much, Mr. Treasurer, and Secretary Grady, welcome.
Thank you, Comptroller Lierman, and good morning to Treasurer Davis and Mr. Lierman. And we'll just echo the Comptroller's comments that I'm thrilled to be here. Excited to hear the report from the staff and Mr. Lierman, and look forward to commenting after we hear the report. Thanks.
Thank you so much, Madam Secretary. And let's move on to the business at hand. We're here to review the findings and recommendations of the Revenue Monitoring Consensus Group and to vote on their March forecast that includes the final forecast for FY 2023 revenues and the initial forecast for FY 24 revenues. And with that, I'd like to introduce Robert Lierman, the Director of the Bureau of Revenue Estimates and Executive Secretary of the Board, to present his report. Before I turn it over to you, though, let me just acknowledge the excellent work of Robert, of Deputy Director David Farkas, of Assistant Director Natalia Mednianets, and the entire BRE team. Thank you all for your work. They're an amazing asset for our state government, and I'm honored to be working with them here at this agency. So Robert, the floor is yours.
Thank you, Madam Comptroller. Just want to also echo your statements, thanking the BRE for producing these estimates while simultaneously balancing our responsibilities during the legislative session, and also the invaluable assistance from the Revenue Monitoring Committee in producing these consensus estimates. With that, I'll turn to our official proposed general fund revenue forecast for 23 and 24. Our forecast projects that general fund revenues will total $23.7 billion in 23 and approximately $24.7 billion in fiscal 24. On an ongoing basis, taking out one-time transfers and similar items, we now project that revenues will grow by 2.1% in 23 and 1% in 24. In total, this is a reduction of approximately $477 million from the December estimate, or approximately 1% of the general fund revenues over this 2-year period. So There's a couple factors that are driving this downward revision in our forecast. The first of which is non-wage income. This is a volatile and hard to predict income source under the personal income tax. And this has been highlighted as a risk given the state's share of this revenue source is elevated compared to historic norms. These income sources, which are typically business income and investment income, are paid throughout the year in estimated quarterly payments. Through quarter three, it appeared that it was going to be a relatively strong tax year, and we're up year to date approximately 8%. However, in the fourth quarter, which is the most important quarter, and they are due January 15th, there was a sudden and unexpected decline in these payments. And as a result, year to date for tax year 22, we are down about 10%. And it does appear that other states have seen a similar and unexpected decrease in this fourth quarter tax year 22 payment. The other adjustments we are making is the board forecasts since December have always incorporated kind of a modest forecast, kind of below trend forecast. And we also had forecasted that growth rates were going to decline significantly from the last 2 years, which we believe were really an artifact of the one-time federal pandemic assistance. And also we had low growth rates given uncertainty about the economic outlook. What was always a little bit uncertain about that is the trajectory of those slowing growth rates and the timing of the slowdown. Based on some recent and preliminary data, we have indications that the Maryland economy is underperforming relative to those modest expectations and also relative to the U.S. economy. So as a result, it looks like our labor market has slowed a little bit more than we anticipated, and consumer spending in Maryland, taxable consumer spending, has slowed. And as a result, we are revising those estimates downward due to the less than expected revenue in the past few months. Next slide. So turning to the specific revisions, the personal income tax is the largest downward revision. About 40% of this total is from withholding, and 60% of the total is from this non-wage income. We are also decreasing the sales and use tax over this 2-year period. However, corporate income tax revenues are running ahead of expectations. This is a combination of greater than expected revenues and fewer refunds. So we're writing up that estimate by about $300 million over the 2-year period. Lastly, with interest rates rising at the fastest rate in about 4 decades, we're getting more interest income. So we've increased that estimate by $50 million in 23 and $25 million in 24. Putting the forecast in context, this is average annual growth rates for the 2 years of the pandemic, the elevated growth rates. The blue bars are the average annual growth rates in the 5 years before the pandemic, what our best idea of our trend rate of growth rate is. And the last 2 bars are what's incorporated in this proposed forecast. Comparing the sales and use and the individual income tax, they tell a little bit different story, but that's distributional effects. Recent legislation altered the manner by which sales and use tax revenues are dedicated to the Blueprint Fund. That share increases, so that's why there's that slower growth in the sales and use tax. On a gross receipts basis, it is a similar growth story than the individual income tax, growing about 1.5% in 23 and recovering to about 2.7 in 24. So on an ongoing basis, we've had these modest growth rates that are not only lower than the last 2 years, but lower than what we think is our trend rate of growth. The December forecast had growth over the 2 years about 1/3 lower. The March forecast has growth rates less than half of what we think is our best idea of our trend rate of growth. Turning to our forecast of jobs, on balance, our economic forecast has been more conservative than our economic consultants, what they produce for Maryland. We have in this forecast, due to this slowing of our labor market, adjusted downward again our projections for the labor market. Specifically, we reduced calendar year 22 from about 2.9 to 2.5%. In calendar 23, we expect growth to be less than half of that. And in 24, we expect growth of about 0.6%. Next 3 slides, I'll have some preliminary data and recent data on the performance of the Maryland economy relative to the U.S. economy. And since this is a short-term trend, we're not sure whether this is a short-term deviation from expectations or a longer trend. In addition, it does not indicate at this point that a recession is imminent. But turning to our comparison of employment in U.S. and Maryland, typically in a recession, the Maryland economy does not contract as much. We usually don't have as much of a job loss. But also in the recovery, we don't share in the boom as much. So we have a slower growth rate. Unusually, in the COVID-19 recession, we had not only a similar decline, but also a slower recovery. In addition, in the last part of calendar 22, that divergence seemed to have widened. But again, this is some preliminary data that can be revised. But it does appear that the factors that are continuing to propel labor market strength in the U.S., which has exceeded expectations for 10 months straight, may not be filtering down in the same manner to the Maryland economy. Had the Maryland economy recovered at a similar rate as the U.S., there would be approximately 75,000 more jobs than there are currently. Another manner in which we're lagging a little bit relative to the U.S. is we're a slow growth state. This chart compares our working age population, which we are lagging a little bit behind the U.S. And there has been a little bit of a decline, a little bit of a sharp decline, I should say, in the last few years from about 0.5% to 0.5% decline. Gotcha. So given the aging demographics of the state, I don't think we can meaningfully expect a reversion to the higher growth rates that we've seen in prior decades. Next slide. Thanks. This is the last comparison of the U.S. and Maryland labor market, the relative strength of the U.S. and Maryland labor market. This is the job openings per unemployed persons. There's a lot of national commentary that the labor market was overheated in the U.S., and it did peak at about 2 open jobs per unemployed persons. In Maryland, we are still elevated relative to pre-pandemic. However, after closely tracking the U.S. economy, we have seen some divergence starting in 2021 and not exhibiting that same strength as the national labor market. One measure of that, it's an incomplete picture, but our unemployment rate is now higher than the U.S., where historically we've had a lower unemployment rate. Turning to our withholding data, in the last 2 years of the pandemic, we had some really strong growth, in excess of 7%. This was well above our typical rate of about 3 to 4%. However, in about spring of 2022, that started to normalize and kind of return to more normal growth rates. However, in the last few months, it has slowed faster than anticipated, and our year-to-date revenues are below the forecast of December. We would have been required to grow, re-accelerate to 8% the rest of this fiscal year in order to reach that estimate. So we have adjusted downward our forecast to incorporate a more attainable growth rate for the rest of the fiscal year. The next two slides discuss the sales and use tax before shifting back to the non-withholding income under the personal income tax. In those 2 years of the pandemic, we had some really favorable trends for our revenue source. First, there was that significant injection of cash. So there was lots of money and there was lots of spending. There was also a favorable shift from generally non-taxable services to taxable goods. However, even though in the U.S., consumer spending is still elevated relative to the pre-pandemic levels, taxable goods has kind of normalized and is approaching levels that were more typical before the pandemic. For our sales and use tax forecast in December, we'd always assumed there would be a significant slowdown as we moved throughout the fiscal year. We had a forecast of about a little more than 7% growth in the first quarter, slowing to about 2% in the last 2 quarters. And although the first quarter of the fiscal year came in line with expectations, in the past 3 months, we have seen another amount of slowing that was unanticipated and greater in the forecast. And this is, again, also why we're revising downward our forecast to incorporate lower growth rates. So the non-withholding revenues, those that aren't related to wages, this has been part of a long-term trend of this increase in these revenues. However, in the last 2 years, there's really been a spike in those revenues. And right now, approximately 1 out of every $5 deposited in the general fund is from these sources. And this matters for 2 reasons. First, as I mentioned, these are really volatile and difficult to forecast. So all things being equal, since our share of the general fund is greater, we can expect perhaps a little bit more turbulence and volatility in our state revenues as we go forward. In addition, since these are harder to forecast, that does create some uncertainty going forward in the forecast, because we're coming from levels that were far from historic norms during the pandemic. A related risk to this is concentration risk. We're getting more and more money from fewer and fewer taxpayers because this revenue is not uniformly distributed. So when you get down to these smaller and smaller numbers, it's becoming less about macroeconomics and in some cases more household decisions. Our capital gains forecast, of which is one source of these non-wage incomes, that has not changed materially from the December forecast. We have updated it for 1 year extra of data, but that was in line with our projections. What this does illustrate for non-wage income, the volatility of how much it does move around from year to year, often maybe not necessarily the way in which the economy moves. And I think this also does illustrate we do have a sharp decline in our forecast, but we still have elevated amounts relative to prior to the pandemic. This chart, I think, tells a good picture of why our revenues have been moving in the manner in which they are, why there's this proposed revision to our forecast, and also why we have some slower growth rates relative to prior years, and some of the uncertainty about the forecast. So these are gross revenues. They don't include refunds and changes in local share, but this gives you an idea of what's kind of contributing to the growth in the personal income tax. And prior to the pandemic, it was pretty stable in terms of year-over-year growth. And most of that was from withholding. Non-withholding income did move around, but not to the degree that it has in the last 2 years, or in the pandemic 2 years. So even though withholding was elevated, we had that over 7% growth. That only really added an extra $200 million in each year. It's really this non-wage income that surged close to $2 billion of it in those last 2 years. And unfortunately, this is not a revenue source that you can just lock up in the bank. It can decrease in the same manner or in a volatile manner, and is more volatile than withholding. So turning to our forecast, for withholding, we're adding about $1.05 billion on a gross basis over those 2 years. However, we're taking out approximately $500 million from this non-withholding income. And that's what's driving those lower growth rates in our 2-year forecast. I should mention as a cautionary note that we're only really reducing about 25% of this recent run-up. In addition, we still have growth rates for withholding of about 4% over these 2 years. If there is a recession or a much greater slowing of the economy, that could take out a significant amount of our growth in the personal income tax forecast. Turning to estimated payments that I discussed earlier, I think the first issue to point out is the shift in taxpayer behavior in terms of the fourth quarter. It is now much more important than it was previously, and this has occurred in the last 2 years. And specifically for pass-through entities, you can see in tax year 21, the fourth quarter, this was a little bit more than $1 billion in gross revenues. In quarters 1 through 3 of this tax year, as I mentioned, taxpayers are estimating that they were going to have a pretty good year, and we were up 8%. However, this fourth quarter, there was that sharp decline of about 1/3 in the fourth quarter, bringing our growth rate, or declining our revenues by about 10%. And 80% of that amount was driven through pass-through entities. And this is one other issue about non-wage income that's important for budgetary considerations, is it's not uniformly distributed throughout the fiscal year. It's not like withholding or sales and use where we get it monthly. We get it on a irregular basis. And as a result, we're now getting more of this revenue, not only after the December forecast, but also after this forecast in the form of final payments. Next 2 slides just pulling together, what this means for our components. The biggest change in tax year 22 was estimated payments, and once the tax year is done, we project that 8.4% decrease. Usually when the fourth quarter is weak, final payments are also weak, and we do maintain a double-digit decline in final payments. However, like these other revenue sources, this is declining from historic highs. Final payments increased by 50% last tax year. And turning to tax year 23, the revision, large revision there is withholding. We've decreased our forecast for that revenue source. Even though estimated payments has increased, the underattainment in the prior tax year is flowing through to that tax year, and we did decrease our final payments estimate for tax year 23 as well. And putting all these sources together, this is the difference in our income forecast under the personal income tax. Turning to the corporate income tax write-up, unlike personal income tax and sales and use tax, those revenues are ahead of expectations, approximately $190 million above the December estimate. We had anticipated The corporate income tax revenues would moderate or decline a little bit after this large run-up. That has not materialized yet, and year-to-date revenues are up 5%. In addition, estimated payments, which are weak on the personal income tax side, continue to show some strength and are up around 10 or 11% year-to-date. However, there can be some lags in the corporate income tax in terms of when changes in the economy are reflected in this revenue source. So in summary, this forecast adjusts to the recent data that we've received in our revenues, and some key revenue sources came in less than expected in the last few months, mainly estimated payments under the personal income tax, withholding income tax revenues, and sales and use tax revenues. So although through the December forecast we were in line with our projections, through the end of January, we are now currently $190 million below our revenue estimate. So we are adjusting our forecast for that underattainment. And this is some relatively short-term data. It's hard to draw strong conclusions about what it means, but it does increase our uncertainty about the economic outlook. It does raise our concern a little bit as well for our economic outlook, but we will continue, as always, to monitor our revenues and economy.
Robert, thank you. Thanks so much. Thank you for the presentation. So my key takeaways are that we are projecting positive ongoing revenue growth this fiscal year and next, 2.1% for this fiscal year and 1% for FY24. But of course, that's much slower growth than what we'd seen in the two previous fiscal years, FY21 and FY22, where we had significant surges in revenue due to one-time federal pandemic stimulus dollars. In essence, I think these growth rates really represent a maturing of the post-COVID revenue boom and our structure. And then finally, the proposed March revisions show decreases in the personal income tax and sales and use tax forecasts, which are offset at least partially by increases in corporate income taxes and interest income revenues. Perhaps more importantly to me, what we're seeing in today's numbers represent a flashing yellow light. Our revenue growth is experiencing a maturing from the COVID response boom, and the state of our economy is showing signs of emerging trends that we need to better understand. Coming out of the pandemic, our economy has undergone and will continue to undergo significant structural changes that are coming into greater focus, such as sharp increases in remote work, the growth of sole proprietors and pass-through entities, and permanent changes in certain industries like leisure and hospitality and retail. We also have an aging population and workforce. At the same time, and very much related, the Maryland economy appears to be underperforming compared to the national economy in terms of employment and consumer spending, which explains the decreased forecasts in sales and use tax and withholding income tax. And on top of that, as I mentioned, we have an aging population that's greater than the national average, ongoing competition for high-wage jobs with our neighboring states, and state coffers that are very dependent on non-wage income tax from the top 1% of tax filers, which of course has proven to be a volatile revenue stream over the years and seems to especially be the case right now. So taken together, I think, we are experiencing a new walking speed, if you will, for our economy, and we have yet to fully define what that walking speed is. These changes are ongoing and they remain fluid. So the economic reaction to COVID is not over yet, and we have not defined this new walking speed. And until we do, we need to be prepared to analyze it, to measure it, and to share the findings with our key economic stakeholders and partners across state government. Thank you again, Robert and the team, for all of your work. I'd like to now turn it over to the treasurer for any comments before we vote on the March forecast revisions.
Thank you, Madam Comptroller. Listen, I get that this is not good news. There's no other way to say that, but it also isn't altogether unsurprising for those of you who attended these meetings, certainly in the 15 months that I've been treasurer. this particular board has been warning of this day for quite some time. We couldn't finger point where the revenue loss would be. All of this is an educated guess when it gets down to it. But we've been predicting the need for belt tightening and things of that nature, like I said, for the entire 15 months that I've been here. So this isn't altogether unsurprising, as was mentioned by the comptroller. As we've emerging or is still emerging from COVID and all the actual money that was pumped into the economy to combat that, things are now, I guess, regressing back to the mean of where we're going to be going forward. But what I would also like to remind us, from the announcement my office made yesterday as it relates to our AAA bond rating, that still speaks to how strong, how resilient, how reliable Maryland's economy remain. In my conversations that I have with the rating agencies, they frequently cite our strong fiscal policies, our various management structures, and other fiscal guardrails for their confidence in our bonds and in Maryland's management, generally speaking. The governor and the General Assembly will do what they have always done when it comes to budgeting. They will be socially responsible and fiscally prudent. Marylanders, I'd just like to say, Marylanders can rest easy despite today's news, knowing that their money is in good hands with their leaders. Thank you.
Thank you, Mr. Treasurer. And one of those leaders whose good hands our money is in is our Secretary of Budget and Management. Please go ahead.
Thanks. Thank you, Comptroller Lierman and Treasurer Davis and Mr. Lierman. So along with Comptroller Lierman and Treasurer Davis, I want to express my thanks to the BRE team and the other members of the Revenue Monitoring Committee for their diligent work and collaboration on this forecast. I've been very impressed with the robust analytic modeling and that the BRE employs, and with the state's consensus approach to revenue forecasting. And I really appreciate the opportunity to participate with this team and on this board. I also want to acknowledge the great work of the treasurer and his team, as well as the comptroller and our colleagues at Legislative Services in achieving the continued AAA bond rating that the treasurer spoke of for Maryland's general obligation debt this week from all three rating agencies. And I want to affirm the administration's commitment to working together to maintain that high standard. As my colleagues have said, the revenue volatility that Mr. Lierman has reviewed with us today is not entirely unexpected, and significant economic uncertainty remains as the nation continues to deal with higher than desired inflation that the Federal Reserve remains focused on trying to rein in. Put simply, today's report means we have significantly less capacity to fund new initiatives and supplemental budget requests for the upcoming fiscal year 24 than we thought we might have as recently as mid-January. In January, the governor proposed a budget for fiscal year 24 with a rainy day fund at the target level of 10% of general fund revenue, or $2.5 billion, and a general fund balance in addition to the rainy day fund of $820 million, of which $377 million was structural balance. The governor proposed a general fund balance and structural balance significantly higher than the recommendations from the legislature's Spending Affordability Committee in December. The governor's motivation in budgeting significant cash reserves and surplus, first and foremost, was to serve as a strong hedge against revenue volatility. Before any additional changes to the budget, the revenue revision today brings that $820 million projected fiscal 24 general fund balance in the governor's proposed budget down to $342 million, just below the legislature's minimum recommended $350 million target. And this revenue revision takes the structural surplus to well below the $100 million spending affordability structural target. The administration is committed to working with the legislature to ensure we maintain the spending affordability targets despite the new revenue constraints. We look forward to partnering with the legislature to finalize a responsible yet strategic budget that positions the state well for the challenges and the opportunities ahead of us. As a state government, we must continue to prioritize financial agility and flexibility to ensure continuation of the core services Marylanders rely on through whatever additional turbulence we might face in the months and years ahead. We will continue to be selective, disciplined, and intentional with our investment decisions. Our constituents and taxpayers deserve no less.
Thank you, Madam Secretary. And I did want to note for those watching and for folks out there, last year the BRE did launch its own new website. So all of this information will be able to be found there at mbre.gov. So now, do I have a motion to adopt the revised forecast of $23.7 billion for FY23 and $24.7 billion for FY24?
So moved.
All in favor?
Aye.
Okay, the estimates are adopted. Thank you again to our BRE team. Thank you, Mr. Lierman. Thank you, Madam Secretary and Mr. Treasurer, and we're adjourned. Thank you.